Morning. Hearing will come to order. This is the subcommittee's first hearing in the 116th Congress and my first ever as chairman. So what do I do with this? It's been 8 years. Before getting started, I would like to acknowledge my friend Mr. Graves from Georgia and thank him for his service to this subcommittee and for his leadership as chairman in the previous Congress. And I hope to be as accommodating, as gracious as he was. And I also want to acknowledge that we have several more returning FSGG veterans, including the chairman of the Commerce, Justice, and Science Subcommittee and the previous distinguished chairman of the subcommittee, Mr. Serrano. Chairman Serrano will also serve as vice chairman of FSGG in this Congress, and I'm grateful for him for assuming that role. Also returning is Congressman Bishop, the distinguished chairman of the Agricultural Subcommittee, Congressman Cartwright, Congressman Amedee of Nevada, Congressman Stewart of Utah, and finally we have 4 new members of the subcommittee, Representative Norma Torres, Representative Ann Kirkpatrick, Representative David Joyce, and Representative Charlie Crist. I look forward to working with each of you on the priorities of your constituents and finding bipartisan consensus whenever it is possible. There is much work to be done on behalf of the American people, and I, for one, am looking forward to a productive Congress where we can conduct oversight of the agencies under our jurisdiction and work to find common ground as we set funding priorities for the federal government. As a matter of housekeeping, we will follow the 5-minute rule for opening remarks, questions, and comments. Members will be recognized in order of seniority based on who is seated at the beginning of the hearing, going back and forth between the parties. Latecomers will be recognized in the order of their arrival, going back and forth between the parties. And at this time, I want to welcome our 4 witnesses to the subcommittee. With us today, we have Ms. Annie Donovan, Senior Fellow at the Center for Community Investment, Mr. Joe Neary, CEO of IFF, Mr. Bob Jones, CEO and President of United Bank, and Ms. Grace Frick, CEO and President of Access to Capital for Entrepreneurs. I appreciate you all taking the time to be with us this morning. I'm excited to get this hearing underway to discuss how community development financial institutions, or CDFIs, benefit the underserved and low-income communities in every state, as well as the District of Columbia, Guam, and Puerto Rico. I know my colleague, Mr. Serrano, is always happy when we hear programs that support the territories. I'll keep my opening statement brief. I want to remind my colleagues that for the past 2 years, the Trump administration has attempted to eliminate the CDFI fund by slashing its funding to a mere $14 million. This is $236 million, a $1 million reduction, which translates to fewer resources to spur economic growth and revitalization in our most underserved and neglected communities. If Congress did not step in to restore funding in both 2018 and 2019, CDFI grant programs would cease to exist in the future. There would be no funds to create new CDFIs nor continue CDFI grant awards for financial and technical assistance, Native initiatives, increased investment in distressed communities, disability, and healthy food financing initiative programs. These programs provide access to capital for communities who otherwise might not be able to create small businesses, local jobs, affordable housing, community facilities, and financial education opportunities. I have a strong suspicion that the current administration will propose yet again to slash the funding for the coming fiscal year, and once again it will be up to Congress to weigh the funding options for this bipartisan program that plays such an important role in generating economic growth and opportunity in some of our nation's most distressed communities. My colleagues on the other side of the dais know the importance and value of CDFI fund. Indeed, the CDFI fund has ranked as one of the top 4 member-requested programs in the bill. In fiscal 2019, the program received 291 requests for increased CDFI funding or report language, and 19% of the requests were from my colleagues across the aisle. I think we all agree on the value of the CDFI fund. In fiscal year 2018 alone, the program awardees financed more than 17,900 businesses and micro-enterprise loans, financed nearly 33,600 affordable housing units, and serve more than 343,000 individuals with financial literacy or training. I'm hoping that we can all work together this Congress to improve lives and strengthen communities that are not progressing at the same pace with other parts of the country. I look forward to hearing firsthand about each of your successes and contributions to building stronger communities and growing jobs across the United States and our territories. That said, thank you all again for taking time to meet with us today, and I look forward to hearing your testimony this morning. Let me turn now to the ranking member, Mr. Graves, for his comments.
Thank you, Mr. Chairman, and congratulations, your new role. And I guess might I add, maybe I'll be as accommodating ranking member as you were. I've learned from you. You were great to work with, and look forward to the many hearings and robust discussions we'll have in the days ahead. And always good to be with my friend, Mr. Bishop, from Georgia as well, and have him on this committee. Great mentor of mine. Welcome. We're excited to have you. You're before a really fun committee here. This committee's got a really diverse jurisdiction that includes funding, sanctions enforcement, tax administration, the White House, federal courts, and many regulatory agencies. And it's under this committee's jurisdiction and leadership, quite frankly, Mr. Chairman, that we'll have the opportunity to help more families and businesses achieve their dreams. And I think that's what this conversation's about here today. But look forward to working with each and every person on the committee, and welcome the many new members to the committee on the new majority side. I look forward to working with everyone there. And then we also have a new member on our side, Mr. Joyce, that he'll be a great addition as well. But want to welcome our witnesses. This is good to have a hearing such as this today to sort of start off this season. Appreciate each of you. I know it's a commitment of time to come and be before us. But you're here to educate this committee on your work, and also those that are watching and those that are participating via online. And but what you do is very important. It's very important for our economy. It's important for our local communities, and you provide great opportunities for people living in a lot of communities throughout our districts. I want to recognize Ms. Donovan. Appreciate your good work. As was mentioned, you're a senior fellow at the Center for Community Investment, and you've served as director now for, 4 years, I believe, and it's been good to work with you in the past, and look forward to working with you and your expertise in the future. And then Ms. Fricks, good to have you as well. Always good to have folks from home come join us. You're founder of and the CEO of the Access to Capital for Entrepreneurs, otherwise we call you in Georgia ACE, and you've done a fantastic job there. Mr. Chairman, they serve 68 different communities and counties in the North Georgia and Atlanta community and areas since 2000, and have made more than $60 million in loans in that short 18, 19-year span, and created and retained nearly 8,000 jobs for folks in our community. So recently named as the Financial Services Champion of the Year by the Small Business Administration's Georgia office. So congratulations on that, well deserved, and I look forward to your testimony. Also want to recognize a good friend and colleague of Ms. Fricks, who's with us in the audience today, and that's Ms. Thelma Johnson. Thanks for joining us all the way from Southwest Georgia. I think you're in Mr. Bishop's district, and good to have you with us as well. She's the president and CEO of the Albany Community Together Incorporated, which has we've been since 2002. So really nice to have you. We appreciate your efforts and what you do and that part of our great state. And for joining us here today and in this hearing. But with that, Mr. Chairman, that's all I have. I'd be happy to yield back, and look forward to a great hearing today.
Thank you again. I appreciate that. And we love visiting down in Atlanta. It's a city anyone would want to live in if it could support a hockey team. But you were so kind in discussing Ms. Donovan. We're going to let her kick things off. And I'll remind everyone, please keep your opening statements to 5 minutes, which will allow time for as many questions as possible.
Chairman Quigley, Ranking Member Graves, and members of the subcommittee, thank you for the opportunity to speak with you today about the CDFI Fund. As you mentioned, for the past 4 years, I had the honor of serving as the CDFI Fund Director. CDFIs are private organizations that invest in markets that lack access to the kinds of safe and affordable financial services needed to pursue the American dream. CDFIs finance entrepreneurs, first-time homebuyers, affordable housing for rent-burdened families, community facilities such as schools, daycare centers, and health centers, and they offer bank accounts to unbanked and underbanked people. In our market economy, capital flows to where it can secure the highest rate of return for the lowest risk. Communities that are deemed too risky or not profitable enough are often bypassed by traditional financial institutions. But CDFIs correct for this market imperfection by using the tools offered by the CDFI Fund to leverage private sector investments in low-income communities. For example, for every $1 of federal investment in the CDFI program, CDFIs leverage $12 of other investments. In the Capital Magnet Fund, $20 of investment is leveraged for every $1 of federal funding, and even higher levels in the Bank Enterprise Award Program. The unique way in which the CDFI Fund supports CDFIs is essential to their success. Most federal programs that target low-income communities either distribute funds to state and local governments according to population-based formulas, like community development block grants, or they fund on a project-by-project basis, usually with stringent rules that make the funds hard to use at the local level. By contrast, the CDFI Fund programs are competitive and make funding available to build the capacity of organizations rather than investing in projects. The kinds of financial assistance awards made by the CDFI Fund enhance the financial strength of CDFI's balance sheets, which in turn allow CDFIs to create innovative and flexible products that make hard-to-finance transactions feasible. Financial assistance awards act like equity capital, but do not demand high rates of return. This equity-like capital is rare. CDFIs blend equity-like capital from the CDFI Fund with conventional financing in ways that fill market gaps and restore market functionality in distressed places. As Chairman Quigley mentioned, the current administration has proposed to eliminate most of the CDFI Fund's programs. Their argument is that community development finance is now a mature industry with ready access to the capital it needs. This argument does not hold up well under the facts. Though CDFIs have grown impressively and continue to punch above their weight, their total assets under management round up to a mere 1% of total assets in the financial services sector. But size is not the only nor the most important way to measure the demand for CDFIs. For that, we should look at whether or not access to capital exists at the scale of the need in economically distressed places. The Urban Institute has compared capital flows in high poverty versus low poverty communities. In a study conducted in Baltimore, Urban found that investments were fragmented by race, income, and geography. Low poverty neighborhoods received 1.5 times more investment than high poverty neighborhoods. Census tracts with more than 85% of residents are African Americans saw investments that were 5 times lower than census tracts where less than 50% of the residents are African American. Nationally, communities with poverty rates of 20% or higher received less than half the investment of communities with poverty rates of 20% or lower. This translates, according to Urban, into an investment gap of $156 billion annually. In 2018, total investments made by CDFIs totaled $11 billion, filling only 7% of the gap. Regardless of where they live, all Americans want the same thing. They want access to good jobs, good schools, health care, affordable places to live, and safe places for their children to play. To thrive, all communities need access to capital, the lifeblood of any economy. As it stands, low-income communities experience wide disparities in access to capital. CDFIs are addressing the gap, though the resources available to them are far fewer than what is needed. If we are to be a nation where opportunity is truly available to all, we need institutions like CDFIs. Chairman Quigley, Ranking Member Graves, and members of the subcommittee, that concludes my statement. I look forward to taking your questions.
Thank you, Ms. Donovan. I would now like to recognize Mr. Neary for his testimony.
Chairman Quigley, Ranking Member Graves, IFF is a Midwest-focused nonprofit CDFI loan fund, which helps nonprofits serving low-income communities to plan, finance, and build facilities they depend on to provide critical services essential to strong communities. My message today is simple. The CDFI fund proves the old adage that Washington doesn't always know best. That's because the power of the CDFI fund is that it is not a one-size-fits-all Washington policy prescription. Instead, its flexible grants put capital into the hands of the local problem solvers best equipped to find solutions to local challenges, allows them to use those resources to raise additional capital, and permits them to recycle and redeploy those funds to confront new challenges. IFF has been fortunate to be one of the first CDFIs to receive a grant in 1996, and since, multiple other program grants in healthy foods financing, capital magnet and disability funds, as well as new markets tax credits. For every $1 we receive from the fund, we borrow an additional $4 from banks to make loans to nonprofits, helping them to finance projects that leverage on the average an additional $3 in overall investment. The result is that every dollar invested in IFF leverages about $12 in total public-private investment. Moreover, these dollars remain on our balance sheet permanently. As loans repay, the dollars are recycled and relent, generating capital into perpetuity. These grants have been essential to IFF's ability to grow its balance sheet and expand outside of Illinois. We were the Illinois Facilities Fund, to serve the entire Midwest, where today 60% of the $350 million loan portfolio now resides. The CDFI fund is the only consistent source of equity capital available to nonprofit CDFIs to grow. With the fund's support, IFF has grown its impact substantially. Since 1988, we've made over 1,700 loans totaling more than $900 million, which has developed 26 million square feet of nonprofit facilities, 75,000 jobs, and leveraged $2.9 billion in total investment. Now, a fair question might be, given the growth and success of CDFIs, why should we continue to invest in them? But I think that IFF's experience in the Midwest exemplifies that there is still a fundamental need for the financing work that CDFIs do. Demand for our loans has never been greater. Poverty is rising and concentrating in suburbs that have limited human services infrastructure where investment is greatly needed. And we have so much work to do in our Midwestern rural and urban communities where real estate values remain depressed and population losses have continued. While this fund has promoted the leveraging of bank capital, the truth is that we have only scratched the surface of deeper public-private partnerships. We need to deploy beyond simple leverage and develop much deeper partnerships between banks and CDFIs and new impact investors in CDFIs. Finally, there is a huge, lasting public policy benefit to the vibrant network of CDFIs that the fund has seeded and grown. I believe that this is one of the fund's most important accomplishments. Yes, we've invested in CDFIs to make more loans and serve more communities, but we have also created a cohort of robust, nimble financial institutions with strong balance sheets that they can leverage to raise substantial capital from the private sector, inject that capital into neglected markets, better manage risks, and have greater social impact. This network of CDFIs remains deeply rooted in communities and as a result have developed significant on-the-ground expertise in education, health and human services, healthy food financing, affordable housing, small business lending, and other issues. Local, state, and the federal government, along with philanthropy, consistently partner with us to address critical public policy issues, which is why the state of Illinois turned to IFF to create the Illinois Fresh Foods Financing Fund to end food deserts in our state, and the Kresge and Kellogg Foundations asked IFF to design the Hope Starts Here early childhood education program to increase quality of Detroit's early ed sector. As I continuously remind my staff, we don't just make loans. We align capital with justice through a powerful toolbox of capital, data, policy knowledge, partnerships, and local execution ability. Thank you for this opportunity, and I look forward to your questions.
I'd now like to recognize Mr. Jones for his testimony.
Chairman Quigley, Ranking Member Graves, and members of the subcommittee, good morning. Thank you for inviting me to discuss the important work of community development financial institutions. My name is Robert Jones. I'm the CEO and president of United Bank based in Atmore, Alabama, and chairman of UB Community Development, the bank's CDFI affiliate. I also serve as chairman of the board of the Community Development Bankers Association. CDBA is the National Trade Association and the voice for banks that are certified as CDFIs. Today, there are 134 certified banks nationwide. First, I thank the members of the subcommittee for their longstanding support of the CDFI fund. We thank you for maintaining $250 million for the fund in fiscal year 2019. Founded in 1904, United Bank is a $631 million FDIC-insured bank that was certified as a CDFI in 2010. Our 18 branches primarily serve counties in southwest Alabama and northwest Florida. Our affiliate, UB Community Development, delivers credit services across Alabama and the Florida Panhandle. The region we serve looks much like most of the rural South. The key drivers of our local economies are manufacturing, agriculture, and small business. While the cost of living is lower than other areas in the country, poverty rates are higher. Alabama ranks 6th in the nation in poverty with a rate of 18.8%. Thanks to the Bank Enterprise Award Fund, United is able to issue responsible credit and financial services to underserved customers. A recent analysis found that 90% of all BEA monies go to the lowest income census tracts. The program helps banks work with financially underserved customers, but the funding does not come easily, and institutions have to prove that the money generates positive externalities in the communities we serve. To qualify for our 2018 award, United Bank had to demonstrate that it increased its total lending in distressed census tracts by $21.1 million between 2016 and 2017. BEA is critical for offsetting the cost of running a small dollar loan program. Several years ago, we used our BEA award to create our Credit Advantage program, a small dollar program for customers with credit scores below 650 or no credit. Borrowers receive half of the loan amount, and the other half goes into a savings account that pays a market rate of interest. These loans encourage saving habits, and they come with financial literacy training. Without Credit Advantage, we would not have been able to help Cassie, a single mother of 5 who worked 2 jobs but still struggled to make ends meet. When Cassie came to United, she had 4 payday loans, one of which had an interest rate of 425%. We helped her consolidate her payday loans into one low-interest, small dollar loan. Today, Cassie is a homeowner who proudly teaches her children about financial literacy. BEA has also enabled United Bank to support small businesses. In 2018, we provided $70.2 million in small business lending and counseled 94 small businesses on planning, budgeting, and cash management. We've also used the BEA award to create the Church Street Incubator, an open format shared workspace that offers technical assistance to small business startups. In fiscal year 2018, banks participating in BEA increased their investment into high poverty census tracts by nearly $578 million. Last year, BEA recipients deployed $3.4 million into persistent poverty counties, exceeding the CDFI fund's congressional mandate. CDFI programs like BEA meet critical needs in rural and low-income communities, but demand for these programs far exceeds funding. I ask that the members of the subcommittee provide at least $300 million to the CDFI fund in fiscal year 2020, including at least $35 million for the BEA program. I thank you for the opportunity to visit with you today and look forward to your questions.
Thank you, Mr. Jones. And last but not least, I would like to now recognize Ms. Fricks for her testimony. Thanks that, I believe, Mr. Graves, it was your crack staff that allowed her to get through on a timely basis. Thank you for that.
Thank you, Chairman Quigley, Ranking Member Graves, and committee members for the opportunity to testify today about CDFIs. I am the founder of Access to Capital for Entrepreneurs, or ACE. ACE is a CDFI loan fund that specializes in growing small businesses in metropolitan Atlanta and North Georgia. In North Georgia, where the beginning of the Southern Appalachian Mountain Range begins. We combine capital with coaching and connections so that underserved business owners can be successful in creating jobs, caring for their families, and contributing to their communities. In 19 years, we have loaned $60 million to 900 businesses who created or saved 8,000 jobs. We started quite small in the back of my house with a $50,000 investment from the Appalachian Regional Commission for a loan pool to help unbanked technical college graduates start businesses like welding, HVAC, automotive repair. We have been humbled, and I have been humbled, to witness ACE grow from a founder's dream with $50,000 to a critical local resource with a loan capital pool of $29.6 million in private capital. I would like to emphasize that CDFIs are public-private partnerships that over time utilize more private capital than public backing. The CDFI fund is the #1 method to build a balance sheet so that an organization like ours can leverage private investment, thus making our organization more self-reliant. I want to share 2 examples of our clients and impact. The first is in Dahlonega, which is in Lumpkin County. Lumpkin is a rural mountain county with 33,000 residents. The county seat, Dahlonega, is home to 7,000 residents. Median income in Dahlonega is just $33,000, and 30% of its residents live in poverty. Tourism provides one of the very few economic opportunities for the area. The reason tourists come there is because of the original gold rush. You see, Dahlonega is actually derived from the Cherokee word Talantica, which means yellow stone or gold. In just the last 3 years, ACE has invested more than $1.5 million in 11 businesses in Dahlonega. These businesses include boutique restaurants, a day spa, specialty toy store, dry cleaner, or wedding venue. Those businesses could not obtain capital elsewhere and business development services to support them. We have helped these entrepreneurs capitalize on their best option for making a living, building successful businesses, and turning their little town into a destination spot. The second example is the Mark and Sagan Academy in Atlanta, Decatur, Georgia. Shortly after leaving the Navy, Colleen Lagan found himself homeless and sleeping in a friend's studio. He used his love of music and production skills to work with a developing artist and found himself in a music deal with CeeLo Green. A few years later, he was inspired to create the academy to teach children music and production skills. We helped Mr. Lagan purchase mixing equipment and provided work in the academy. That academy provides it has 43 students enrolled and employs 1.5 FTEs plus 2 interns. Today, 85% of our lending is in metropolitan Atlanta. 48% of our loans are to African American business owners, 8% to Hispanics, and 48% to women. Nationwide, CDFIs like ACE are investing in some of the poorest communities in America. These communities are comprised of working families with extremely low incomes, high rates of poverty, and unemployment. They lack access to affordable financial services, and CDFIs step into that gap. I urge the subcommittee to provide $300 million in funding for the CDFI fund. This increase of $50 million would leverage some $600 million, providing much needed capital. We are making a tangible difference, serving disinvested urban areas, rural areas, and areas of persistent poverty left outside the economic mainstream for decades. I appreciate the opportunity to share more of our work in Georgia, and I'm happy to answer questions. Thank you so much.
Thank you, Ms. Fricks. I appreciate your thoughtful testimony and all our witnesses, and I appreciate the derivative of the word Yellowstone. Chicago actually comes from Native Americans who originally lived in the area, Chickaqua, which means striped skunk. So it's not quite the same impact as Yellowstone. The other definition might be a smelly onion, really. So, and there's an election there today, and The Windy City actually doesn't come from meteorological conditions, believe it or not, because of our elected officials there. Who knew? And out of deference for time, I'm going to begin the questions by deferring to Mr. Bishop. He has to run across the hall. We all have a lot of hearings scheduled across the Capitol today. Mr. Bishop.
Thank you very much, Mr. Chairman. I appreciate your deference and that of the committee in allowing me to go first. I do have another hearing, but I certainly wanted to be here to welcome our witnesses, Ms. Donovan, Ms. Fricks, Mr. Jones, Mr. Neary. I especially want to give a shout out to Ms. Fricks, who brought along with her my friend of long standing, church member, and fellow Albanian, Thelma Johnson, who's with Albany Community Together. Let me just welcome all of you, and we really appreciate your discussions on the value of the CDFI program. According to the Wall Street Journal, between 1995 and 2015, the percentage of rural areas and small towns without a local bank increased from about 12% to 32%. Mr. Donovan and Ms. Fricks, the great need of the financing that's provided by CDFIs for low-income and rural communities continues, as evidenced by the applicant demand in the FY18 CDFI program round. The CDFI fund received 700 total applications requesting a combined $505 million for financial assistance and technical assistance awards, Healthy Food Financing Initiative awards, Persistent Poverty County awards, and Disability Funds Financial Assistance awards. In addition, 124 CDFIs applied for $218 million for the BEA program. How does this compare to the amount available in FY18 and the demand in previous years? And I'm going to ask my second question quickly because I'm going to have to run, so you take note. Ms. Fricks, can you discuss the impact that access to capital for entrepreneurs has had in helping Black-owned businesses in distressed areas of Georgia? And had Congress approved the President's FY19 proposal for only $14 million for the CDFI fund, what impact would that have had on Black entrepreneurship in Georgia nationwide? And how would it have impacted the racial wealth disparity that currently exists in the United States? And let me just say that my district is 50-50 rural-urban, and as the chair of the Agriculture, Rural Development FDA Subcommittee of the Appropriations Committee, I have a real passion for rural economic development and for improving the quality of life of Americans that live in rural areas. And so this CDFI fund and the way that it can be and has in many instances been utilized to improve that quality of life and the opportunities there is very impressive. So can I get you to address those two questions for me, please?
Yes, let me start with the big picture. I am pleased to say that CDFIs who are accessing resources from the CDFI fund outperform with respect to the allocation of resources that go to rural areas. So about 15% or so of our population lives in rural areas, and about over 20% of the activity with CDFI resources is directed to rural areas. When you look at persistent poverty, about 6% of America lives in persistent poverty communities, and 18% of CDFIs are headquartered in areas of persistent poverty, and 1/5 of CDFI investments are going into areas of persistent poverty. So I think this is the great, this lets us know that the policy of the way that we certify CDFIs and require them to put at least 60% of their assets in low and moderate income communities and in targeted communities, and the way that we run the competitions at the CDFI fund is effective at targeting resources to the places that need it the most. I think our biggest problem is, again, back to the scale of the CDFI sector and the need to grow to a bigger scale.
Ms. Ricks? What impact would the FY19 proposal from the administration have had on what you do and what CDFIs do?
I think I might still be sitting here because our program, after the recession, also began serving metropolitan Atlanta. I don't think Dr. Adams Johnson, Thelma's program, would be sitting here. There's just an extreme difference in serving the rural market and serving a metropolitan market. When I said that, right now 48% of the small business owners we serve are African American business owners, that is because of us having offices in Atlanta also. And when I talked about the amount of private capital that we have been able to leverage, that's because of having that Atlanta market as part of ours, where the Albany area in the same amount of time has maybe done $8 or $9 million worth of loans. And that's because there's less capital, there's less resource there. And I think you know that in the rural areas, there's an out-migration of banks. And then Georgia was the #1 state in the country for closing community banks, and that impacted all of us. We have become, in rural areas, the go-to for lending. And for what you're seeing is more people being vulnerable to predatory lending when there's no community bank or CDFI in their area.
Thank you, Ms. Ricks. Thank you all. Mr. Graves.
And just sort of maybe a question that can inform all of us, and I'll ask Ms. Fricks and Mr. Jones as well. And feel free to respond to, and Mr. Chairman, I don't know how you want to, multiple members on a panel, I know it's hard to decide who's going to answer a question, but the federal government oftentimes is trying to help communities, and there's a lot of different agencies and different programs that get established through multiple administrations or different majorities and such. And I guess for our perspective, and I know that the request will be, you mentioned $300 million, and the administration is at a different spot there. How can you share with us the difference it makes through the CDFI program versus the many other programs that are out there that you might interface with or have to work with that can help us understand there's not a duplicative nature, or that this is impactful, that it is needed, and that it's worth that investment? Because at some point we will have to make decisions, and they're tough decisions. It'll be, do we put more in this bucket, or this bucket? And so I think that would help this committee a little bit as we try to make decisions in the future about the, I guess, spreading out the different resources we have. So we can just start, Ms. Ricks, with you, and just help us understand that a little bit.
I mean, logically, just like you're thinking, there should be, I think it's what BB&T and SunTrust have called in their merger or buyout synergies, which were really efficiencies from combining departments. I think in the best of all possible worlds, that makes some sense to do some of that. I can tell you that the CDFI fund is the only one. Its purpose is to help build balance sheets so that we can do more using private capital. And some of the other programs, they have their purpose. USDA is strictly rural. It's difficult. It's difficult for you.
Well, you've given some great success numbers, statistics here that are fantastic, and I don't know that we hear those from all agencies or other areas that come before us, so this is very helpful. Yeah. Mr. Jones, yeah.
Thank you, Mr. Graves. I probably would speak specifically to the Bank Enterprise Award, which is unique to insured depositories. And the beauty of that program is it gives institutions like ours the flexibility to create products and deliver unique services into the communities we serve. The flexibility of the program has been talked about, the local delivery with people that are committed and invested to the local community, identifying specific needs. There's high accountability to the use of those funds. We have to prove that we're using them appropriately. It is unique. It is the only federal program that's for for-profit banks. And as Ms. Fricks mentioned, there's a continuing challenge amongst around the country for our presence of community banks. If in 600 counties in this country, if there were not a community bank, there would be no financial services provider there. And as has been pointed out many times over, to operate efficiently in this economy, you have to be a part of the financial mainstream. And the gateway to that is most times through a community bank by basic financial services, checking and savings accounts. And as I indicated in the story I told, how we assisted people with no credit experience at all to build some resiliency. The BEA allows us to do that. There are unique challenges as an insured depository that oftentimes the confluence of regulatory pressures with the economic pressures that banks experience. The BEA gives us the latitude to be innovative, to create unique products that otherwise wouldn't exist, that are really tailored to the most distressed members of our communities. The flexibility is important, and that's why we're advocating for continued support of BEA and increasing its funding.
Thank you.
I'd like to add that 1 is 12. So $1 of CDFI federal dollars becomes $12. So when you make an investment, when you make those choices around where dollars should go, remember that if you cut 1, you cut 12. So if you add 1, you're adding 12. I think the leveraging that CDFIs do in the marketplace is a really powerful tool. I think the second piece here is that, you know, many of the challenges that all of the federal departments work on are complex, they're interrelated. CDFIs are part of helping implement those public policy decisions and make those other programs more efficient and effective. Again, because they leverage the private sector to deal with the capital side. So if you're looking at early education, if you're looking at fresh foods, if you're looking at the social determinants of health, there are many factors that go into working on those challenges and the funding of federal programs. CDFIs are the capital fuel to working on those public policies.
Ms. Donovan, I'll start with you. You talked about, I guess, the way to reference it was the gap. In your assessment, what is the scale of need that exists for credit and capital in these distressed communities? What amount are we missing, if you can assess it?
Yes. Well, the research there's not a whole lot of research out there, but the research that has been done by the Urban Institute, I think for the first time quantifies the neighborhood of that gap, and their numbers show $156 billion. And that's the difference between capital that flows to communities that have poverty rates of 20% or greater versus ones that have poverty rates of 20% or lower. And you know, the growth in terms of investments that CDFIs are making in low-income communities is impressive. Even over my time, over my 4 years at the CDFI Fund, it went from roughly $5 billion to $11 billion. And still against a gap of $156 billion, that's not much. So when I hear my colleagues arguing for $300 million, you know, I would like us to go much higher than that because, again, you have to look at the scale of the problem. It's CDFIs are addressing 7% of the problem and doing amazing work, very effective work. But there's so much more to be done. And I would just also say that it's not just a matter of the money either. CDFIs offer development services alongside the financing. They partner with local organizations. They partner with national organizations. They are magnets for bringing resources, braiding them together, and structuring them in ways that can be absorbed by the local community that needs them.
Yeah, my second question dealt with that, and that's aside from budgetary resources, you know, what else can CDFIs, what can the fund do to help build the capacity of CDFIs?
Yes, this is very much needed. At the Center for Community Investment, where I'm serving as a senior fellow right now, we refer to this as the capital absorption capacity of places. So some places, even if you have capital swirling around, it has to be able to land. And to do that, you need people on the ground who are able to do the kinds of work that CDFIs do, to organize the demand side of capital, to make sure that communities can responsibly take the capital in and use it well. And to do that requires capacity building. And I know during my time as CDFI Fund Director, we would get the question about, you know, is it the most effective way to invest in capacity building, because we want the dollars to go directly into communities. And I think that it is important that the predominance of the funding go directly to CDFIs, but small and medium-sized CDFIs and CDFIs in hard-to-reach places will tell you that they need the capacity building that the CDFI fund offers through the capacity building initiative. And 1% to 2% of the budget, I think, is sufficient to provide that kind of capacity building.
Do others want to weigh on that? Ms. Jones?
I would just echo what Annie was saying. I think that resources are scarce, obviously, as we have already talked about. I think the effective deployment of it, and one of the real strengths that the BEA program has, or some of the other CDFI funds, it puts the monies in the hands of local organizations that have the capacity, the resiliency, and the connections to make a meaningful impact in those communities in a way that just a general allocation of dollars. There's an accountability. You know, in the BEA, we must have at least 30% in areas of poverty and 1.5 times the national unemployment rate. So by definition, those monies are going to the most severely distressed. So when we look at the types of alliances and partnerships that have been talked about, one quick example in our organization, we have our staff volunteering in the VITA program, which is a voluntary income tax assistance program. Since we've been a part of that, we've done 585 tax returns totaling $670,000 in refunds, of which $218,000 was in earned income tax credits. In the year 2017 alone, we saved individuals over $20,000 in tax preparation fees. Those are hard dollars that have gone directly in the hands of distressed families in a community that otherwise those monies would have been allocated elsewhere. That alignment and the ability to use those funds to provide those programs make a real difference in communities and families where, frankly, are living paycheck to paycheck. So it is effective.
I want to go ahead to Mr. Amadei.
Thank you, Mr. Chairman. You know, I don't think, just speaking for myself, when I hear things like 12-to-1 leverage and stuff like that, I don't know that, in my mind anyhow, that it's like, well, is this a good program? Is it a bad program? Obviously, if it had more resources, I would assume that you would continue to leverage those and grow those and do good things. But I'm a guy who comes from a state that's had about 8 of these programs awarded or whatever, and I'm sitting there looking at that, comparing it to other states with similar population, whatever, not that it's apples and apples, that have been much more successful. So I guess my question to this panel, as people who have a lot of experience in this, is it financial infrastructure? In other words, do I need to go to the State Bankers Association and say, hey, how come? God forbid I say the word credit union in here, them too, you know, or whatever. But anyhow, is it like, listen, is there no infrastructure in the state promoting this? Or is the quality of applications defective? Or is it just we're not applying? I mean, because I started to get off on the urban-rural thing, and it sounds like you guys know how to say and spell rural pretty good. And so, I mean, help me a little bit in terms of saying, hey, it's a good program, sounds like it's doing good work where it's well dug in and whatever. But what are the indices of that in terms of making that a tool? Because I've got communities with populations like you've talked about where the county sheriff is also the dispatcher and the patrol person. So that tells you about the health of the community. And by the way, ones where I think we've got 2 community banks left in the whole state, which, you know, the bankers tell me, well, they're good things, we want to preserve them. So anyhow, whoever feels like taking a whack at it, go ahead.
Sounds like it's right in my wheelhouse. Let me tell you a quick story, maybe can speak to exactly what you're talking about. Our bank's been around since 1904, so we're not new off the street. We were certified in 2010. During my career, I served as the president of the State Bankers Association, have served on the board of the American Bankers Association, have been involved in the industry for basically almost 30 years. I really didn't know about the CDFI fund or the initiatives here until we had an opportunity to get certified in 2010. Our journey since that certification has been one of discovery, and we have been an ambassador to other financial institutions because it's a little understood and not widely known segment in the industry. There are 134 banks that are CDFIs. I think disproportionately the impact that those institutions make are significant in the communities they serve. I can't really speak to why it has not been more widely known. Annie and I have talked about that in previous times. I think that what we're doing in our state, we were the first, amongst the first to get certified. We are the first and only to receive new market tax credits. We were the first to get a Capital Magnet Fund award. We were the first to get a USDA Community Facilities grant. There's more conversation because of the work we're doing, and I think the more mature this industry becomes, and it's very new, and particularly in the rural areas. Very early on, most of these programs are urban-centric. I don't know that they're nationally or otherwise, there was a true understanding of the challenges in rural America that only now has become a topic of conversation. So I would say it's too early to make that determination. I'm optimistic that we'll see an expansion of that. That's part of the mission we have with CDBA. I think the performance that we're having and the impact that we're making, as I visit with members of our delegation, they're intimately aware of how we're deploying these dollars. We're accountable to them to report the programs that we're administering, so it is making a difference. The state is beginning to recognize it. So I would say don't judge it too soon. The work that we do continues to make an impact, and I think the story grows from there.
Well, and I appreciate it. I'm not judging it too soon. I'm just waiting for the day when there's somebody on the panel from Nevada, which, by the way, does not stand for some kind of skunk or something, some way to say gold without saying gold. But anyhow, it's just like, it looks like a tool that's a legitimate tool.
Yes.
And so
it really, the reason why the CDFI fund is as successful as it is in our market economy is because it takes the principles of the market economy. It's market driven. And so, but it presumes that there's a capacity, there's a baseline level of capacity at the local level. And so it requires that kind of capacity building. So, you know, the communities that have strong philanthropy, there's communities that have a banking sector that are dedicated to place and have strong partnerships. That's where, and it's probably not due to bad applications. It's probably the capacity at the local level, which is why it's important to take just a little bit of the budget and put it toward capacity building initiative.
And if I could, just one complimentary comment on that. I'd be glad to come to Nevada and talk to some bankers and help see if we couldn't get more capacity. I think one of the issues that regulated institutions have, and this is something I'd encourage the committee to give some consideration to, regulatorily there are challenges for an insured depository operating in this challenge space. So at times the purposes are at odds with each other. An alignment between the regulatory structure and the community development structure can make a meaningful difference in terms of broader application and deployment of these funds.
Thank you, Mr. Chairman. Thank you. I yield back.
Thank you. Preliminary research says Nevada means covered in snow. so I'll take the skunk. Mr. Christ.
Thank you for doing that.
Thank you, Mr. Chairman. I am from Florida. We're known as the Sunshine State, for the record. I want to thank you, Mr. Chairman, and thank the witnesses for being here today. We appreciate your testimony and educating us further on CDFIs. I grew up in South St. Petersburg, Florida, a vibrant, economically developing, majority black neighborhood. I am now humbled to represent here in the United States Congress. Minority-owned businesses are the bedrock of that community. Businesses like Chef's Creole Cafe on 22nd Street, known as the Deuces. Carolyn and Elihu Brayboy run that restaurant. It's all about spicy jambalaya and second chances. Second chances for a neighborhood returning to greatness, and second chances for the ex-offenders that they employ. But this great American story would not be possible without Community Development Financial Institutions Fund. It was a CDFI lender that finally said yes to every other traditional, when every other traditional lender would say no. So, Ms. Donovan, when it comes to issues like sustainable development, eliminating food deserts, and restoring communities, can you quantify what a CDFI would mean for places like South St. Pete?
Well, that's a challenging question.
It's not meant to be.
So for communities like South St. Pete, absolutely having a CDFI, as you mentioned, there to, like Ms. Fricks mentioned in terms of what they're able to do in the communities that they serve. They were probably able to make that loan because of the way that their balance sheet is structured, back to having resources from the CDFI fund that allow them to be flexible and to take the risk. And to take the risk that banks wouldn't take, or I want to add, wouldn't take a loan, because a lot of the power of what CDFIs are doing is bringing their own resources to the table in a way that allows the bank to say yes. There very well may have been some bank resources in that loan that was organized and managed by the CDFI in order to make that access to capital available.
Thank you. On the issue of access to capital, I'm sure that all the panelists agree that when a black barbershop needs a quick loan to replace a broken chair, the owner should not have to go to a payday lender. No one else will say yes. You all agree that that's wrong, I assume? I do too, and that's why I brought together lenders and women and minority business owners for an access to capital fair that we had in my district. We invited lenders of all shapes and sizes to come and meet entrepreneurs at various stages of their business development. Out of all the lenders who showed up, fully half were CDFIs. Florida Community Loan Fund, Black Business Investment Fund, Suncoast Credit Union, and the Tampa Bay Black Business Investment Corporation, to name a few of them. Mr. Jones, why are CDFIs so excited to provide access to capital to the women and minority-owned small businesses that traditional lenders do not?
Well, I think we clearly understand the importance of small businesses and the impact they can have in a community. Part of the mission that we have in our CDFI role, because the challenges in communities are so multifaceted that none of us singularly can solve all of them, but we can focus on the parts that we can make the most impact on. Our experience has been in job creation. We, as I mentioned in my opening statements, we operate a small business incubator. And perhaps the best way to describe how we've helped that segment that you're most sensitive to is we had a lady that came to us that had an idea to be a home health care provider. This is not nursing care, but assisted care so someone can remain in their home. She had the idea, but didn't have a business plan and hadn't had the experience to do it. We invited her into our business incubator, which immediately gave her credibility with clients that she had an office space and someplace they could come meet with her. Today, she has operated that business and now has 9 employees that are working for her. As a result of us working with her, helping her with some credit startup and providing a space, which is critical credibility for a small business. Another story, we had a minority young lady who wanted to be in the photography and wedding planning business, had a great idea, needed the help to get started. We brought her into the incubator, helped her with a business plan. She's now operating out of a standalone space downtown and is adding to her capacity. So I think there's an opportunity to do that, and the CDFI is operating in these communities that are developing a network. And within certain communities, it's word of mouth more than anything else that you do. You walk the walk rather than just say you're going to do these things. And they become the ambassadors, and I think that opens doors for future opportunities and changing, in these two cases, the resiliency of two ladies that now have an operating business.
Thank you, sir. Thank you, Mr. Chairman. I yield back.
Thank you. Mr. Ranking Member, do you have another question?
Just follow up, yeah.
Yes.
It's funny, I was sitting here thinking, Mr. Chairman, that you referenced hockey in Georgia, but I think Mr. Jones and I, and maybe Ms. Fricks, we appreciate a different Saturday sport in the fall that maybe you don't quite have the same understanding of in your state. SEC football is amazing, yeah. And it's always good to have somebody from the SEC here as well. But a quick question, I wanted to drill in just a little bit on something you were saying a minute ago, Mr. Jones. You seem to have a unique role that you have a community bank that is a full-service community bank, but also operate in a CDFI component as well. And I really don't know the answers to these questions, so help me walk through it. Is there the possibility based on, and this is what I think I was hearing you say, that the rules and the regulations are so challenging in the banking industry today, is it possible that there is a customer that could come to you and seek a loan in a traditional format and maybe not qualify for it or not be able to get it, or maybe it's too cumbersome or too expensive, that then they can go to a different office in your same facility, your same building or branch, and receive a loan under a CDFI concept? That's
an excellent question.
And if so, why is that? And
well,
how do you smooth that out?
We could spend the rest of today talking about all the reasons behind, but let me touch on some very high-level issues. True story, back years ago, we had a finance company that the bank operated. And it operated to provide that option that you just described to people that otherwise couldn't perhaps meet the regulatory requirements for a bank loan. There was a rule change within the regulations which told us that within the finance company we had to treat them like bank loans. We had to close the finance company as a result of that change in guidance from the regulators. As soon as we closed the finance company, payday lenders moved into the void. As we've gotten into the CDFI space, this is a conversation that we have openly. We use many other programs to provide enhancements to those opportunities that might need an SBA guarantee or an SSBCI. We have a rule in our bank that no one officer can decline a loan. It takes two. One officer can make a loan, but they can't decline a loan. And we do that for the very purpose of taking a second look to see if there's something maybe we didn't see in the first application. In the small dollar loan program that I mentioned in my opening comments, our rate of loss is 10% compared to consumer loans that run around 2%. The BEA allowed us to present those opportunities and continue to make those loans to help people build credit because we all understand, and particularly the members of the committee, that until you get a credit score and you get into the mainstream financial system, you're operating off the grid. And that's a place that's not sustainable to take advantage of all the opportunities we offer in this country for home ownership or upward mobility. So we see that as something critical to what we do. We have a nonprofit side in our company as well that we fund. We're beginning to operate and we'll set up loan funds to provide that tier of financing to small business or other types of entities through the nonprofit space as well. Specific to the community development subsidiary you mentioned, we set that up as we were successful in winning awards in the new markets and other areas to create the ability to deliver those across the state of Alabama. We've received 2 new markets awards as a result of those applications, $120 million. To date, that's created $165 million worth of capital investment, and it has sustained or created 3,000 jobs, and we continue to expand that. We operate our Capital Magnets or our LIHTC program out of there, which is providing 730 housing units. across the state as well in 14 developments. So it has allowed us to move from just the traditional community bank, which we still operate in our traditional counties, to becoming a statewide entity to move into these census tracts that are most in need in a state like ours. So the creation and the opportunity to be a CDFI is changing many of the communities that we participate in. So I think it takes the willingness to do it. As I mentioned in my comments, the regulations often are at odds, and to be able to navigate that. And we often have to educate the regulators to what it means to be a CDFI, but that's becoming more accommodating.
So it is possible that a potential customer could come in and seek a loan in a traditional format and not qualify and be redirected.
Yep. And we provide some other safety nets in terms of unsecured lines and to our checking accounts, which provide a $500 safety net if they need that short-term availability. So,
has there ever been any concerns, been my last just thought on this one, Mr. Chairman, of institutions, in essence, cherry-picking customers and saying, you know, okay, we'll keep the ones that are more qualified or have a better potential to pay back and redirect those others to the CDFI type program? Do you ever sense that throughout the community, or bad actors, so to speak, you know, taking advantage of that?
You know, we often see people seeking the path of least resistance or available credit, which aren't on the most favorable terms. But I have to tell you, as a banker, some of the best things you can do for people sometimes is tell them no. And to just grant credit without a reasonable expectation of managing it does more harm than good. But we also provide financial counseling, so that if we can't do it, then we sit down and tell them what they need to do to improve their situation. And many times, that experience of being told no, then coming back and say, okay, I did this, now what? And how can I improve my situation? Or we'll put them into a reloadable prepaid card and help them manage that, or get them into a checking account, or offer them a small secured credit card. Now they're beginning to build a capacity. Frankly, our country does an abysmal job in training people how to manage their personal finances. And I see that as a foundational failing. That until we help people be better consumers and wiser consumers of credit, this is self-perpetuating. We'll always be fighting this problem. So the root cause is very, very problematic. So we make a difference one person at a time, and that's all that you can do. And I think that's all every one of us at the table do, is small steps, but that's how we approach it.
Okay, Ms. Jones, great words. Thanks.
Thank you. Mr. Neary, in 2017, CDFI Fund receives specific funds to support programs, projects aimed at assisting individuals with disabilities. It's relatively new, and congratulations to IFF for receiving an award to assist individuals with disabilities. Can you explain to the subcommittee how IFF is using these funds, has used these funds, how you're going to measure the impact of the funding? And if more CDFI funding were available, how would you use them?
So IFF was actually really incredibly honored to receive that award, partly because lending to nonprofits serving people with disabilities began at our inception in 1988. And since then, we've lent over $50 million to nonprofits serving those persons with disabilities. We're also one of the founding members of the CDFI Disabilities Coalition. For us, this work has obviously been very important, and we concentrate the funding that we've received from the fund and in the past in two specific areas, although again, we lend broadly to nonprofits working in that space. But two focus areas, which are employment for persons with disabilities. The unemployment rate amongst people with disabilities is the highest in the nation, as well as independent living or housing for persons with disabilities. Unfortunately, Congressman, we live in a state which does a horrendous job of creating housing outside of institutions for people with disabilities. So examples of that are projects like our Loan to Hope Homes Foundation, which is in Representative Joyce's district, where we help stabilize mortgages for that organization to do small community integrated group homes for people with developmental disabilities. or our loan to Paraquad, which is a Center for Independent Living in St. Louis, where they used our loan to create the only fully accessible gymnasium and workout center for people with disabilities in St. Louis, as in addition to a restaurant called Bloom, which employs persons with disabilities in a restaurant that has become one of actually a pretty popular spot in St. Louis. It's also why IFF partnered with Access Living, which is a Center for Independent Living in Chicago, to create a subsidiary called Home First, which finances, develops, and owns housing for persons with disabilities coming out of institutions. And to date, we have about 200 and some units scattered site throughout the city, county, and downstate Illinois that serve persons that were formerly in nursing homes or in other types of institutions. So we are obviously very excited that this fund has allowed a focus on what is possible in providing capital specifically in this space, and hope that encourages other nonprofits to begin to think about how that capital can then advance the issues for persons with disabilities.
Ms. Donovan and whomever else, we 425% interest on a loan. Anything else we can do to create, this can be used to create alternatives to payday lending, and recognizing that it is not a complete evil. For many, without payday lending, they're not going to get their water heater fixed or their car fixed. So what else can we do to help?
Well, in I believe it was the 2017 budget, the previous administration put forward a proposal to invest $10 million in the small dollar loan program, which is authorized through the Dodd-Frank Act. And I think that program, funding that program, would, in the same way that other programs have shined a light on activities like disability or healthy food financing, would allow more resources to be available to fund the work that Mr. Jones talked about he's doing in his community. There's a much greater need for that, and so I think funding that program and directing resources in that way would increase the amount of activity.
Anyone else?
I'd like to just expand on that just a minute. I am aware of the proposal that came out of the Obama administration for the $10 million request. It was part of Section 1206 of the Dodd-Frank. I certainly agree with the premise that we need to help customers. I mean, it goes without question. That's exactly what we do. But I think the $10 million should not be taken out of the existing funding. It should be in addition to anything else that the committee considers, so that if we're looking at an allocation of those dollars. But I think one of the things that also has to accompany that, other than just dollars, is like I mentioned in my previous comments, is that I would encourage the CDFI fund to work in conjunction, particularly for those of us in the insured depository space, with our prudential regulators. I think the partnership between the alignment of giving institutions such as CDFIs the flexibility to create products that can solve this problem and not run afoul of unintended consequences of some regulations that are not designed to speak to the unique needs of this specific community. Banks are very sensitive to their reputation risk. In these types of loans, you can inadvertently do something that could create an adverse outcome. And you don't want to do that because you're trying to do good work. And so I think an alignment between the fund and the prudential regulators could create an opportunity for helping to address the problems that you're addressing, Mr. Chairman. The money is important. I think it would be helpful, but without that collaboration, I'm not convinced it would be as efficient or as effective as it possibly could be. We have to align the interest, because I think we're all wanting to do the same thing, serve the communities, and we need to. There are unintended consequences. You know, it's like the old expression, no good deed goes unpunished, and you can't afford to do that. And that's why I think sometimes we see a void created because of that.
Thank you. I want to thank all of you. And before we conclude, I want to ask unanimous consent to add a letter from the Credit Union National Association addressed to myself and the ranking member to the record. No objection, thank you. I want to thank the members who participated, the staff who helped put this together, and of course our participants. You were extraordinary. This has been very, very helpful. We look forward to working with you again in the future. Anything else, Mr. Ranking Member? No. Thank you all very much. Have a good day.